Mark, I got to say, $3 trillion is a staggering number in such a short amount of time. Is this something that could have even more legs to the downside?
Well, thank you. And look, nobody knows how far this is going to extend and what the hit to growth will be in the first quarter. But I think that there are things that investors can do about this. And so one of the things that we've been doing is now switching allocations towards emerging market equities from developed market equities. And that's actually been working over the past week.
What exactly is it about the emerging markets that makes them so attractive, given the fact that we are seeing such a hurt put on them because of the China situation? You would think that emerging markets might be the ones taking the hit the hardest.
Well, I think there's two factors there. One on the shorter term and second on the longer term. So we've seen now that China, to a degree, is several months into this and is actually starting to bring people back to work. We're seeing more stimulus measures in China and in the Asian region. So they're further along in this. They panicked, I would say they panicked early and have started to come out of that to a degree now. And I think that's why the EM indices are starting to perform better here now than some of the developed markets. So we're overweight EM equities versus European equities. And in Europe, as this unfolds, when you look at things like central bank options for policy options, they're more limited in Europe. And that's why I think this is a trade that investors can move towards.
Do you feel as though this is an environment right now? We've shown 5 straight days worth of large losses for the Dow Jones Industrial Average. U.S. markets are taking a pretty big hit on this. Is it fair to say that there is still a bull trend longer term that's intact for markets in the United States?
Well, as I said before, we don't know where this, if it's a V-shaped recovery, how deep that V will be, or if it's going to morph into a U-shaped recovery. Certainly, we know that as the virus has moved further outside of Asia, it will have more of an impact on growth. But I do think there are some factors that we need to consider, and they've been in place since post the financial crisis. First, central banks and governments have taken a larger role in participating in the economy and providing stimulus, and they can do that because the interest rates are so low. And so that trend certainly remains in place. So I think that while the inflation is low, we have more policy options. And of course, in the United States, the 10-year has come down now. That will lead to refinancings and the ability for more people to get financing. But there is still room for the Federal Reserve to act, unlike, say, in Europe, where the rates are already negative.
Mark, before we let you go, we've heard an argument made by some experts out there and some market watchers that central bank intervention, whether it be from the Fed or anybody else that has a concern over the coronavirus, has a more limited ability this time around because it's a supply shock issue. It's the economy there not necessarily having a demand problem, but that you're shutting down supply chains. The whole economy might be slowing down. Is that then reason to worry more that the Fed cannot necessarily rescue us this time around?
Well, certainly, as we go through supply chain shocks, you're right, the Fed can't rescue us. However, I would leave you with one thought, which is that while markets are pretty good about pricing the decline in growth around disasters like this, our research shows if you look at something like the Fukushima disaster, where you could argue that the Bank of Japan has had limited ability to take action for some time, what markets are also bad at is pricing how quickly substitutions and other things can take hold and actually how fast growth can resume once the disaster has passed. So it's not necessarily saying that that's the case this time, but it's also not a time now for investors to panic when we saw that $3 trillion of market cap decline. Diversification and focusing on some of the longer-term themes that are going to come out of this, the focus on e-commerce, the focus on the future of food, where people care more about where their food is coming from, and the focus on genetic therapies are all longer-term themes that more and more people are going to understand as we come out of this coronavirus crisis.